Welcome back, friends. I am joined today with Keith Hobart from Peak Mortgage, and we are going to talk about refinancing in 2025. Welcome, Keith.
Yeah, thanks for having me, Joe. I appreciate it.
Yeah, so let's dive right in. We've got some questions here that we'll go through. First and foremost, what are some factors that should help homeowners decide whether to refinance?
Yeah, great question. Refinances, a lot goes into it, and there's a lot of pros and cons to each scenario. Everyone's scenario is different. So, kind of what we're looking at right now, especially in a little bit higher rate environment, is hey, what's debts do you have to pay off? I mean, we focus a lot of that on what consumer debt you have, what's the interest rate that you're paying on that. So while you might have a little bit lower interest rate on your house, depending on when you bought in the last 3 to 10 years, it might make sense to get rid of that lower rate and give that up for a little bit higher rate if you do have a bunch of equity in your house.
Nice. So you're talking about like doing kind of a cash out type where you can pay off some consumer debt, is that?
Exactly right. Yep. We're running into a lot of those scenarios. Credit card debt's at an all-time high right now in America. And if you're buying cars or anything right now with a loan, those rates are a lot higher than they had been in the previous years. So there's a lot of opportunity there to use the equity in your house. And yeah, your mortgage payment might go up a little bit, but you're actually going to be getting rid of a lot of consumer debt to help bring down your overall monthly obligations.
Nice. Yeah, that makes sense to me, especially with how much equity people have built up over the last several years.
Yeah.
Got it sitting there, you might as well get the low rate on it. And I guess that kind of jumps right into the next one. Like, what's the, how does refinancing save? And then is there a break-even point for costs involved? Or what do you have, as far as recommendations on that?
Yeah. So if you're talking to any lender you're talking to should be able to give you what the break-even point is on that. So again, every instance different. There's millions of different scenarios. Somebody's break-even point might be 3 months if they're in a really weird, unique situation. Other people's break-even points are usually more in that 1 to 3 year time frame. So again, just make sure you're getting all the opportunities out there that are available to you. See which one makes the most sense for you, kind of given your long-term and short-term financial goals and making sure that aligns with it. So definitely doesn't make sense to refinance if you're just going to turn around and sell your house in 6 months, or if you're planning on, if you really don't have the savings there right now either too. So
yeah, that makes sense. And so like if somebody's sitting down and looking at a refinance, basically whoever they're talking with should be able to kind of break everything down, show you the cost, show you what it's going to look like for you and your payment savings and all that stuff.
Yep, exactly. Yep, make sure you're getting all that information. So the more information, the better on a refinance. And a lot of this can be done up front too, right? Before I even have you make application. Just having a conversation with you, figuring out what your goals are, what you're trying to achieve, and just getting basic information from you and making sure it aligns with your goals.
Yeah. The nice thing about a refi versus a purchase is there's not really a deadline, a time frame that you have to worry about. You can kind of take your time, do your investigative work, and make sure you're getting the right info.
Yep, exactly right.
Are there any specific loan programs with refinances or other incentives in Washington that might incentivize somebody to do it? Or
over the past couple of years, we've seen a lot of or a handful of lenders, right, offer free refinancing.
Right.
Is essentially kind of what I tell everybody is, hey, there's no such thing as a free lunch, right? So you're paying for that one way or another. So a lot of times what they mean by that is they're just going to waive their in-house lender fees,
right,
just to get you to come back and refinance. Now, I will say be cautious of that because a lot of those companies might already have higher interest rates than, say, a competitor would, because they're relying on people not to necessarily go shop around.
right.
So definitely be really aware of that. Just because the lender that you did the purchase with said, hey, come back, do a free refinance with us. Again, it's not free. They might be taking advantage of the situation. So shop around, talk to different mortgage brokers, and make sure you're getting the best deal out there. Because even if you do find another lender with that is charging you lender fees, their rate might be lower and they're actually saving you money by going with somebody else. So just be aware of that.
Yeah, definitely want to do your full investigation on that. And then the question I get a lot is just with refinancing, they do have to run your credit again. So could potentially be some credit score impact. Do you have any advice on that or how much that should be a concern?
Yeah, it shouldn't be a huge concern. Again, I can do a lot of investigation stuff up front without necessarily pulling credit from you to make sure it makes sense. And to make sure that it's even a possibility. And then if we get down the road and it looks like this makes sense for you, a lot of the good lenders out there will actually have soft pulls that we can do if you're really worried about your credit. I will need to eventually do a hard pull. It'll affect your score a little bit, but honestly, in the overall scheme of things, not really. It's one of those things that we have to do if we want to move forward on it. But a lot of the good lenders out there have ways around that if you're really concerned, or if you're right there on the brink too of maybe not having the best credit and you're worried about qualification purposes.
Yes. Yeah. Yeah. I think that's important to know too, that no matter where you go, they're going to have to pull your credit at some point. It's going to have to happen.
Yep, exactly.
Just a matter of when and how often. On that note, I guess there's a lot of question about if someone does go get it pulled multiple times, is it still the case where if they get it pulled multiple times in a certain span, is it one?
Yep. And so basically, the credit bureaus don't want to penalize you, right, for shopping, which is a great thing for the consumer. Protect the consumer, make sure they are able to have the opportunity to go out there and get the best deal possible. So correct. If you have multiple mortgage pulls in a 30-day window, it's still looked at as one. So if you go somewhere and your mortgage lender tells you not to go pull your credit, be wary of that. It's probably because they're afraid you're gonna go shop them, and so don't necessarily listen to that. That's pretty bad advice. And yeah, it's
that is great advice.
Yeah, so
yeah, that's really good to know. And then key differences between rate and term refi and then a cash out refi. Obviously, there's a couple of options here, which is not something we typically run into, of course, with the purchase finance. So can you kind of dive into those a little bit?
Yeah, yep. So those are the two most common refinances that you're almost always going to come across, unless, again, it's one kind of weird one-off situation. But a rate and term is exactly what it sounds like. So basically, we're just refinancing the rate into a lower rate. We're not pulling any cash out of your house. And so the goal on those is you can come up with money out of pocket if you want to on the refinance, but usually we're aligning it to where your cash to close is basically zero. So you're not having to come up with any money, but you're also not getting any money back. So that's a rate and term. Cash out is, again, exactly what it sounds like. We are tapping into the equity in your house, pulling cash out. The big differences on those two is a cash out refinance. The rates are higher on that. So keep that in mind, especially if you're comparing, if you're looking at both scenarios. Just know that on average, it might be 1/4 to 0.5% higher in rate by pulling out cash as opposed to a rate and term. So
gotcha. Is there on that with cash out? What's the limit, like loan to value? And then I'm assuming they're gonna have to have another appraisal on that to make sure that they're not exceeding the value of the home.
Yeah. Yep. So again, great question. You are going to be capped at a much lower loan to value ratio on a cash out. Typically we're in that 80 to sometimes 85% loan to value ratio. That is the most we can tap into. We're on a rated term refinance. We can basically go up to your original loan to value ratio if we need to from your purchase if it is that high. So it's both good options, but again, it's just going to depend on what your scenario is. What are you looking to achieve, and what parameters do we have to work within?
Right. And a little 1/4% higher is nothing compared to a 30% credit card or whatever.
Right.
I've heard some crazy stories lately of rates on those with the number of defaults and everything seems to be skyrocketing lately too. And then a question we were just talking about, and I seem for some reason this year I've gotten more questions over the last several months about adjustable rate mortgages versus fixed rates. Dive into that a little bit. What's the one, any insight into why I'm hearing more of that, but also what are the considerations there?
Yeah, not sure why you're hearing more other than just necessarily typically in a higher rate environment, adjustable rate mortgages are going to be a little bit better priced. What we're seeing right now is it's actually pretty consistent with fixed rate mortgages. There might be an occasional time where adjustable rates are going to be a little bit better, but if I'm kind of taking the law of averages over the last couple of years, they're pretty much kind of been right in line with fixed rates. Essentially why that is just investors don't have the appetite for adjustable rate mortgages right now. They are basically thinking along the lines that we are going to have rates get improved over the next few years, hopefully. And if rates do come down, then essentially they might be missing out on opportunities, future refi opportunities, if they did offer a more traditional adjustable rate mortgage rate that is lower than the fixed rate at the time. So
gotcha. Yeah, and it seems like right now, I mean, rates are higher than they've been, but it seems like, at least if I was doing it, I'd probably look for a fixed rate because the risk just with so much uncertainty right now seems with no benefit, it just seems like the risk of an adjustment it just doesn't make sense.
There's no benefit to it, right?
Yeah.
I mean, if you're talking a full percent difference, then all of a sudden we'll start doing a lot more arms.
Right.
But until that gap widens between fixed and adjustable rate mortgages, I definitely encourage a lot of people to just stick with the fixed rates.
Take the sure thing.
Exactly.
And then, are there any tax benefits or implications that folks should know about when they're refinancing? Obviously, like capital gains tax when you sell is a big thing, but anything with refis that somebody?
Yeah, not too much out there. I mean, I will always preface this with, hey, talk to your tax professional, talk to your accountant, right? Essentially, hopefully the tax savings is not necessarily tax related, but maybe mortgage insurance rate related. If you're able to refinance and not necessarily always get it off, but get it lower just because your loan to value ratio has increased. So that's one of the benefits to refinance a lot of times is able to get you lower mortgage insurance if you do have it. When it comes to actually tax benefits, there'll be some things you can write off on along the lines of the refinance costs that you might be able to write off. But again, you talk to your tax professional about that. They'll let you know.
You're not a tax pro?
No, definitely not.
Any mistakes or anything that you see that people should avoid when they're looking at refinancing? Any big pitfalls, or is it pretty straightforward?
I see a lot of mistakes where people just kind of get pigeonholed into one idea. Definitely talk to a mortgage professional. I mean, talk to somebody who knows what they're doing and who can offer you great rates as well, right? I hate to say it, but just because the previous person did your purchase doesn't mean that they're necessarily the best person to do your refinance. Get out there, shop around. I will tell you this, just to go back to the person that did your purchase, even if you had a great experience with them, that's awesome. But when you're refinancing, I mean, it's a business decision and you want to save yourself as much money as possible. Don't fall for the gimmicks of free refinances and things like that. There's a lot of smoke and mirrors out there that some lenders play with, unfortunately. So just shop around, just talk to multiple lenders, make sure you're getting a good deal. Go with the person that you like, that you feel comfortable with, is going to do a good job. But you're already in the house. So there's not that same sense of urgency as when you're buying your house. You don't have moving trucks lined up in the driveway, things like that. So even if it takes a little bit longer, it's not the end of the world.
Yeah. That's even advice I give to buyers when they're very rate conscious. When you're purchasing, that's not really the time to be super, conscious about it. Take your time to refi.
Exactly.
So get your home, get settled in, and then figure out what the best path forward is. I think you can lose a lot of opportunity if that's all you're focused on when you're buying is rates. You can lose opportunity.
And again, talking to somebody knowledgeable who's going to be able to communicate with you about maybe your interest rate is at 5 right now. If we refinance it, maybe it goes to 6, but we're going to pay off a whole bunch of debt, right?
Right.
So you got to think outside the box, and not just getting pigeonholed into one idea of, hey, I just got to do a rate and term. There's a lot of cost opportunities out there, a lot of opportunities out there to save money, and just got to look at the cost benefit of each one. So
yeah, and for most people, mortgage interest deduction is now you can't write off your deduction on your auto loan interest, but you can on your mortgage. So again, just other ways to save on that.
Exactly.
Really good question. And I know we kind of hit on it early on, but if somebody's looking to sell in the next number of years, at what point does it make sense to refi versus not? I guess, is there a time period in there that you have advice on for when it makes sense?
Yeah, definitely goes back to my last answer is making sure you're talking with somebody who's a true professional and knows what they're doing. Just because, if you're looking to sell in the near future, every time you're doing a refinance, you should know roughly what your return on that is, how long it's going to be for you to break even on that. And so again, whether it's 6 months or 6 years or somewhere in between, you need to know that number to make an educated decision before you go refinance. Because even if I could refinance you and save you a few $100 today, if you're going to sell that house in 6 months or 9 months or a year, it may not make sense for you to do it. A lot of things to look at. When it comes to mortgages, just like houses, there's no one size fits all for everybody. Everybody's situation is uniquely different, and you need to talk to somebody who's going to ask you a bunch of questions, get the information they need to help you make the best decision for you and your financial goals.
And then make a plan and go forward.
Exactly.
Cool. Well, I really appreciate you taking the time today.
Yeah, my pleasure, Joe. Thanks for having me.
Having you back.
Yeah, thank you.